Well, thanks so much for tuning in to Navigating Through Uncertainty. I'm your host, Neeraj Shah. And boy, these are uncertain times, as we've told you. Our guest today needs no introduction. Adrian Mowat, a veteran of the emerging market in the Asia-Pacific space for a number of years now. And it'll be great to understand from him, how does he think of the current landscape and the impact that the landscape could cause to the Asian markets or the emerging markets, as the case may be. Adrian, great having you. I hope all is well.
Yes, everything is good. Although, as you say, it's very challenging times. It's not easy managing a portfolio in this environment.
It certainly isn't, and I'm glad I'm not the one doing it. Adrian, I was looking at a Credit Suisse note which suggested and which analyzed how that when one looks at the previous instances of 3 percentage points hikes in the US, only once, and I think they've figured out that it was only 1993-95 when the US escaped a recession. Now, is a US recession your base case? And if that is the scenario, what impact does it have on the Asian or the EM markets?
So I don't think it should be your base case that you get a recession. So we're going into a tightening cycle, but remember we were starting with effectively near zero interest rates, and now we've got the futures market suggesting we'll be around 4% by this time next year with the Fed funds rate. And I would argue that the long bond, which is the yield has come off a bit, and it's effectively implying, let's say, an inversion if we were to get to that 4%, that the bond market perhaps is more in the recessionary camp. Now, why should we go against that consensus? There are a number of things to look at. Corporate balance sheets look very healthy. And so we go into this difficult environment with a corporate sector that has a good balance sheet. It's also a corporate sector that has lived through 2 years of a pandemic with some extremely challenging business environment to deal with. The household sector in the developed world has generally got very good balance sheets as well. And what we're seeing is a rapid decline in the savings rate as people tap into their savings in order to maintain consumption. So I think there's a good chance we can avoid the recession. And perhaps the narrative, the way that this works, is that the corporate sector in the US is already announcing freezes in new hirings. Some of the more edgy tech are beginning to announce some layoffs. So I think the US household sector, who currently feels they have huge job security, probably could push for higher wages, that confidence begins to moderate as we go into the second half of the year. And so you don't see the same wage inflation that people are fearing that would push the Fed to have to cause a recession. Now, let's go back to late November 2021. We started to hear this term Omicron, and the South African scientists had sequenced the Omicron variant. So let's not forget that is 6 months ago. So we then went into a period of time where the number of Omicron or COVID cases expanded dramatically. And in January this year, there was a genuine concern that that would lead to significant hospitalization, significant death globally. You have many countries that were reimposing travel bans. Here in Hong Kong, there was travel bans on many countries. There was 3 weeks quarantine if you were to find a flight to come back on. And so this was the dynamic that we were going through in the first quarter. So imagine you're running an airline. Do you, in the first quarter of this year, hire a lot of staff? Do you bring your aircraft back from storage? Well, it was a bit of a gamble to do that. And we could use that analogy across many industries. I was in Thailand recently, and the tourism industry there, which is very, very important, almost impossible to plan. And so what we're seeing here in the second quarter of 2022 is a significant demand shock on a service sector that could never be expected to have ramped up to deal with this shock.
In which case, Adrian, would you suspect, therefore, that the worst of the fears might come unfounded, and the fact that the inflation scare goes down, and since the market looks ahead, the markets might start feeling a bit more optimistic about the pace or the eventual destination of the rate hikes, and thereby what the impact could be on multiples and on growth?
Yeah, my base case with that would be the market psychology journey in the third quarter of this year, which we're almost into, actually, let's be fair. I think there's a reasonable chance that the June CPI printout in the United States will be another negative shock. But that's a backward-looking data, I would argue. But that could be sufficient for another down leg. And let's not, I mean, this is one of the most vicious down legs I've ever seen in a bear market experience, really since the middle of last week, sorry, in the middle of the week before last. Markets looked as if they were recovering, and then we've had a very, very aggressive downdraft in a market that had already been weak all year. So I'd be very surprised if investors' confidence is going to recover in the next couple of months. But that said, those with a bit of duration should be thinking about being more on the buy side than the sell side at the moment. But it's going to be one of those, hard experiences where, markets are generally feeling very, very tough. And if you're wanting to make money over the next couple of weeks, I think that's going to be incredibly difficult. But I look out there and I look at well, let's talk about specific stocks, like an Amazon's on 2 times sales. The price of this thing is pretty much halved. Amazon has doubled its warehouse capacity, employees in the last 2.5 years. So what you're going to see, I would imagine, from Amazon is maybe even some layoffs, but you start to really utilize that capacity. I'm not particularly worried about the recession risk for some of the core components of tech, like cloud computing, etc. Definitely growth rates could slow, but demand remains very strong for those. But if demand for data continues to remain strong, then you do need the hardware that goes behind that data in those data centers that we maybe are not aware of when we're playing with our iPhones. And I think there's quite a lot of interesting stuff on a one-year view. It's always very hard calling markets short term.
Sure.
If we're right that perhaps we've gone past peak Fed fear, we're right that bond yields could stabilize at this level or even come down a bit, then looking back towards growth stocks away from value, which has generally been the style that's outperformed this year, is where I think the most constructive opportunities are. I wouldn't be telling people you must aggressively buy these things at the moment, but this is the place. Do the research, have some strict limit orders, and think about a return you're going to be making over the next couple of years by buying into these types of stocks.
You reckon that the narrative around the opening up of the Chinese economy, maybe hopefully the conflict easing, would be more powerful than the quantitative tightening as well as higher rates?
I think it will be. And so if we go to QT, and as emerging market investors, we know how painful the tapering scare was back in 2013. But remember that in 2013, the Fed was expanding its balance sheet. Then in early 2013, Kuroda-san, the governor of the Bank of Japan, announced their quantitative easing. And you had a huge rally in bonds, particularly more risky bonds, such as emerging market bonds, including onshore emerging market bonds. And when in May we read those minutes that talked about tapering, you then got a shock into the US bond market, which then delivered a shock to bond markets where people's positioning was incredibly bullish. And that's not the case at this point in time. So, and I think the way that the market will ultimately interpret QT is it is tightening. but probably it leads to lower bond yields and a lower neutral Fed funds rate because you are shrinking your balance sheet, right? Now let's see. This is a very edgy time for markets. So we've got QT starting end of July. We've got the next FOMC meeting. Second week of July we'll have the CPI print. And so it looks like an environment where probably if you have cash, keep your cash and see how this goes. It's obviously it's harder if you're already positioned to know what to do at this point in time. But remember that QT is tightening, and if all things are equal, it should mean the other forms of tightening, such as increasing the Fed funds rate, are more modest than they would be if you hadn't had QT. The other point I would say about tightening is there's already been massive tightening in the US financial system. And you see brokers like Goldman Sachs, they publish their financial condition index, and it's already very tight. A headline number would be mortgage rates going above 6% in the United States. That's caused a collapse in mortgage origination. So there's plenty of evidence of the tightening already being there. And I wonder whether the actual effective tightening, we've had more behind us than we're going to actually have ahead of us.
Oh, okay. Let's wait and watch. So in which case, Adrian, how does this place Asian markets and India in particular? Because in India, we haven't had the episodes of large bits of, benefits given by the government in the first place. The balance is probably as it was. If anything, the tax collections are looking fairly impressive. And the point that you made about corporate balance sheets across the world, that probably holds true for India as well. So how do you look at Asia and how do you look at India in light of the factors that you just mentioned about the West?
So, I've been looking at India for a long time. We used to only ever have the wholesale price index to look at. And I have to say, if you look at that today, we're at 15.88 or something, which probably makes sense because we can see all these commodity prices have gone up. The CPI number, which I think is 4.9 is the most recent print, 7.4, is lower than the US, which is interesting. And it's higher than it has been in India, but I think the level of inflation shock is probably lower in India than other markets. But if we go back to the China discussion, China's running an inflation rate where the big figure is 2. And pork prices in China, which obviously not important in India, but in China very important, they're down 22% year over year. And so I think for China, if they can get away from this very destructive zero COVID policy, it's a very bullish story for their equity market. And because they can ease policy, there's pent-up demand, and they don't have this inflation headache. I think it's harder for the Reserve Bank of India. And the Reserve Bank of India will need to tighten. I think if you look at the consensus, they're really going for 200 basis points maybe over the next 12 months. I think that should be sufficient, and my logic would be that India will go through a period of weaker growth because the cost of living shock has an impact on the demand for goods and services in the economy, and that the best thing may be for the RBI to be patient. I don't see any particular stress on the RBI from, let's say, currency markets or capital flows. The rupee is weak, but it's not, and I've already described a yen that's at 135. So on that basis. So I suspect what you see on the Indian market will be near-term consumer staples, defensives outperform a bit. But as we move into, let's say, the end of the third quarter, I think it might become a little bit more of a cyclical story. Where I'm struggling in just thinking about banks globally is banks are usually a great hedge against inflation because, if the nominal economy is expanding, then their balance sheets can expand with the normal economy. You obviously run into issues like credit quality. But I want to go back to this. Remember that we've been through a global pandemic. And so it's been a very abnormal, a very adverse period for 2 years. To me, that's not an environment where you get, credits being issued that are very poor quality, that are top of the market type credit being issued. So top of the market, I mean, loan officers reducing credit standards, just thinking a bull market's going to continue in whatever asset class. So I think banks are interesting here, and it's going to be this play between the environment actually looks pretty good for banks' earnings, with the exception of investment banks where ECM originations and stock markets are down. But I think the bank environment is actually quite interesting.
You mean bank earnings across the world? I mean, even in India?
Yeah, I mean across the world. And a lot, banks, particularly banks with a big deposit base, do benefit from higher interest rates.
Sure.
Now you'll get accounting balance sheet issues. You'll get mark-to-market losses on bond portfolios, etc. But normally, stock markets look through those positions. Because it's a lot of the bank's balance sheet is often held, or bonds are held to maturity. So I think there'll be a lot of noise around this, but broadly speaking, I think banks are actually a pretty good story in an environment of relatively high nominal growth.
Got it. Adrian, one final question, and that is on technology across the world. Right now, tech is that big space where most people are invested in. Higher rates would mean potentially lower multiples, especially for some of the ones which are discounting a lot many years into the future. Indian tech is slightly different than the world tech in that these companies are not so egregiously priced, and the models are very, very too. How do you see world tech, and then how do you see Indian tech?
So look, we have to accept the fact that inflation is surprised on the upside. Discount rates are going up quickly, driven by fears of what the central bank's going to do. And that is bad news for expensive growth stocks. And expensive growth stocks can continue to fall in this type of environment. But I think you make a very good point here, and I must go and actually look at the numbers. I was looking at the numbers from the perspective of Microsoft and how Microsoft derated from 2000 to very early 2003. Microsoft's current PE is lower than what it got to in that phase. One of the hard things when we go back to that period is many of the companies in today's NASDAQ were not around back then. So you're kind of left to Apple, Microsoft, etc. And the Apple business today is not the same business it was back then. So I think you make a very good point on the Indian IT names. And I used to own, obviously, your Infosys and Wipros back then. I suspect the PE multiples are probably quite similar, but I'll need to go and double check. But the businesses are a lot more mature. And perhaps India's going to face less of a wage inflation delta than you might be seeing onshore in the United States, right? So if you're a corporate entity in the US and you're looking to manage your costs, then the Indian IT vendors may provide you with a good method of managing your costs more effectively.
Got it. Great. Adrian, this is lovely talking to you. Thank you so much for taking the time out and being with us, and wish you all the best for the remainder of the year.
All right. Thank you.
Thank you for being with us, and viewers, thanks for tuning in.